Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. There are a lot of growth stocks on the market today that a lot of us probably haven't even heard of. And there are a few that we interact with on an almost daily basis that are really fundamental to our lives that provide a lot of growth but aren't household names. So I want to go through 5 of those growth stocks that you may not know about, but you probably may want to at least put them on your watch list, if not in your portfolio. My name is Travis William. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And I want to start with a company that has been around public markets for quite a while. Probably a technology that's in a vehicle you either own or have ridden in recently, and that is Mobileye. Here's a look at some of Mobileye's solutions. They go all the way from a driver assist program to all the way to autonomous vehicles. They have things like front cameras, sensors that go on vehicles, the system on a chip, so basically the processing system for autonomous vehicles. And they're working with a number of different manufacturers, whether that's providing component parts that go into a larger system that an automaker designs themselves, or whether they're just integrating Mobileye's technology into their vehicle. Sort of the long-term vision for this company is to be able to make vehicles that are going to be fully autonomous, that look a little bit like this. Maybe goods delivery is the example that they give, mobility as a service, and public transportation. From a financial perspective, Mobileye is now just coming public again. It was acquired by Intel and then spun off again. So you can see the stock only goes back less than a year. Not a cheap stock, trading for 50 times next 12-month earnings, and on a next 12-month basis, 12 times sales. That's a very expensive stock, but this is one of those markets that is really just getting started. We've had sensors like this in our cars for a very long time, but we're just starting to adopt them from an autonomous driving standpoint on a more wide basis. Let's go through a few of the financials. This is a look at Mobileye's revenue. You can see that revenue has really surged coming out of the pandemic. Remember, during the pandemic when production of vehicles was lower, that's the reason that we see a lot of these drop in sales here. But as sales have picked up, so has revenue for Mobileye. I'll add net income here on the bottom of the chart. You can see that the company is not profitable right now, but it's not far from profitability. And so if the company can grow revenue as we have more of these autonomous vehicles hitting the market, I think we can get to profitability pretty soon. And this will just be one of those companies that if you're interested in Mobileye, you see the long-term vision, what autonomy looks like 5, 10, 20 years from now, not just necessarily the sensors and the systems that they're selling right now. I've been investing more and more in autonomous driving, and this is just one of those companies that I think is going to play a key role, whether it's actually designing the entire system and selling that to automakers, or whether it's designing and selling components that go into other systems. I think Mobileye is just going to have a big place in the industry. This is not the kind of industry that's going to be dominated by just one company, and so being able to serve a lot of different companies with their products is going to be really helpful. That's why I think this is the kind of growth stock you want to just buy and forget about for the next 10 or 20 years. The second one on my list is another growth stock that's really trying to grow into a more mature business, and that is Matterport. If you aren't familiar with Matterport, this is a company that turns video and LiDAR images into a 3D capture of a space. It's called spatial computing. They also call the output digital twins. And then the company can do a number of things with that. They can help you design out a commercial space. If you're looking at renting something out, they can count the number of sinks or sprinkler heads or other assets that are in a building. And that flexibility has been both the benefit and the challenge for Matterport. I think the technology is phenomenal. The challenge is how do you get it into markets? Because when you look at something like their industries, residential real estate, so you may have seen this on something like an Airbnb. You can actually do a virtual tour or a home tour if you're looking at a new home. Commercial real estate, architecture and engineering, insurance and restorations, that would be where you can save a digital version of your home or your apartment and say, hey, these are the assets that we have in here for insurance purposes. Facilities management, travel and hospitality, manufacturing, just a ton of different use cases, but there's no one silver bullet. So it's kind of trying to get the industry to adopt Matterport in a million different places, and that has kind of been the challenge. It's one of the reasons that the stock has not done particularly well on public markets. You can see that with the overview here. You can see that shares are down over 90% from their peak during the pandemic in November of 2021. But look at this over here. The market cap is $703 million, basically no debt on the balance sheet, and $445 million worth of cash. So an enterprise value on a net basis of just $259 million. That is not a lot to pay for a company that is growing and is starting to turn around its operations. Here is a look at trailing 12-month revenue for Matterport. You can see now about $157 million. You can see that the company is losing money, $227 million worth of diluted net loss for the last 12 months. But those losses are coming down, and a lot of those losses actually stock-based compensation, which when you have a very volatile stock like this, stock-based compensation actually becomes very expensive, even though it's not a cash cost. You can see this chart is showing cash from operations, and since hitting a low in 2022, that has actually improved pretty significantly. Only about a $12 million loss in cash from operations. For Matterport, the strategy is to improve the technology and then increase the use cases of that technology. And the challenge has really been that a lot of the businesses that they're trying to get into have very, very long sales cycles. Construction is the kind of business that doesn't really change very often, so it can take very, very long to start getting used in those kind of use cases. Same thing with insurance and commercial properties. So I think this is a technology that has a lot of potential. Investors are getting a reasonable value. There's a long runway with that amount of cash that's on the balance sheet. And there are some great partnerships that Matterport has come out with companies like Amazon's AWS, with Autodesk. Still a lot of potential for Matterport in the future. There's just a lot of work to do to get to the point where this is a stock that really lives up to its potential. But it is a growth stock, and I think it's trading at a pretty reasonable valuation right now. So absolutely one to at least put on your watch list. The third stock that I'm going to cover is On Holdings. This is a company that makes primarily shoes. Running shoes is really where they started, but they moved into things like tennis and casual shoes. Just a phenomenal growth brand in the athletic space. And I want to show a couple of charts that just show how impressive this company is. Here's the trailing 12-month revenue numbers for On Holdings. You can see that in 2020, $480 million in revenue. In the last 12 months, that has more than tripled to $1.74 billion. And that momentum is still continuing. Management is expecting to grow in excess of 30% this year. They've had a lot of success, not only with their shoes, which are becoming more and more popular, particularly with adults who can spend a little bit higher price on the shoes that they have and the performance that they're getting. They're also moving into more apparel products. So that's, I think, a potential growth market. And then a number of markets that they can grow around the world from a geographic standpoint. They've had a lot of growth in North America, but there's a lot of potential to grow in certain countries in Europe. They have a high adoption. This is a Swiss company, so they have a high adoption there, but there's other countries that they can definitely expand into. And then Asia and South America are definitely growth opportunities as well. From a valuation standpoint, On is an expensive stock, but not crazily expensive, but not overly expensive, especially compared to some of its competitors. If we look at the enterprise value to sales ratio, next 12-month enterprise value to sales was 4.1. That's not the cheapest stock that you'll find, but for a company that's growing in excess of 30%, I think that's a very reasonable multiple. Not a lot of earnings for On, but I do want to point out this is a company that is generating positive net income and positive cash flow as it's growing at a really, really rapid rate. That's extremely hard to do in the product space because you typically spend a lot of money on things like sales and marketing or manufacturing costs. You have to buy inventory. That's a cash cost that a lot of companies really struggle with as they're growing. So On is managing this really well, and they're maintaining extremely high margins. They have better margins than most of their major competitors and higher growth rates. So I think this is the kind of fitness stock, could be the next Lululemon in the fitness space. I just think it's a phenomenal brand, and they manage their growth really well. Another company that continues to grow and has a lot of growth potential is Portillo's. This is the restaurant company. They're known for their hot dogs and beef sandwiches. It reminds me a little bit of Chipotle 15 or 20 years ago when they were just starting to roll out on a national basis. They were very big on a regional basis, but they were just starting to really expand in earnest, and that's where Portillo's is. I want to highlight a few things from their most recent earnings presentation. This is the same store sales growth on a quarterly basis. You can see that that growth is starting to come down, but that's as people are starting to spend a little bit less eating out. But remember, this is a number that's still growing. So keep that in mind, 12% overall revenue growth, and that's despite the fact that they don't have most of the new stores for this year operational. Here is the development update that they have. Most of their restaurants, they have 76 restaurants currently operational. Most of those restaurants are in this region right here, specifically right around Chicago. They have started to expand into Arizona, Texas, California, Florida. Interestingly enough, their most successful restaurant today is in the Dallas area, generating $17 million per year in revenue. Just an astounding number from a single restaurant. On average, their profitability from each restaurant is about $2 million. So as they expand into some of these markets, I don't know if we'll see that $17 million number again, but we could see some very big numbers. They're expecting to add 8 new projects this year, and then probably an equal number, if not a little bit more, next year. You can also see the steady revenue growth from $455 million in revenue in 2020 to $627 million in the trailing 12 months. Same store sales doing very well. Remember, 2020 was that outlier year with the pandemic. And restaurant level adjusted EBITDA is a proxy for the cash flow that's coming from each restaurant. And that is very healthy in the mid 20% range, coming down. The reason it has come down over the last year or so is because of higher commodity costs, so higher input costs, both from a primarily higher food cost, but they have also increased wages for their workers. And that increased cost has not yet been passed on to customers in the form of higher prices. So I would expect this margin number to steadily go up over time to be in that mid 20% range. Again, like I talked about with On Holdings, another company that's growing profitably. Very difficult to do when you're growing because you're spending a lot of money on development, but there is positive net income despite the fact that they're growing so quickly. The long-term financial targets, I think, are what investors really need to think about. 10% unit growth annually. So that's the number of stores that they have. Same store sales growth in the low single digits. So if Portillo's can grow revenue 12 to 15% per year for the next 10 years, that would be an astounding growth rate. This is the kind of compounding that long-term successful businesses do. And that's why I love where they're sitting. Very profitable, very popular. The stock can still be relatively expensive because Portillo's is not focusing right now on profitability on the bottom line as they expand their stores. But this is the kind of growth company that I just love right now. I love where they're positioned. It reminds me a lot of the growth restaurants that we've seen over the last 10 to 20 years. And the final company to go over today is Taiwan Semiconductor. This is a company that may be in the device that you're watching this on right now. They make the chips for Apple. They make NVIDIA's chips. It's really the high-end manufacturing company for the world today. And it's not only a growth company, it's very profitable as well. Here is a look at revenue and net income for Taiwan Semiconductor. You can see $71.5 billion of revenue in the past year. That is up from $32 billion in net income, $31 billion, just an astounding number and a phenomenal percentage, nearly a 50% net income margin for Taiwan Semiconductor. And that's up sharply from, if we look at 2018, about $12 billion in net income in 2018. So just a phenomenal growth company as we use more chips and we try to pack more density into those chips. This is a company that I think is going to continue to grow. If we look at the snapshot and overview for the company on a price to earnings multiple, a trailing basis, you're getting the stock for 14.6 times earnings. Just a very valuable company at a relatively reasonable multiple. That enterprise value to sales multiple is 6, but remember, very, very high margins for Taiwan Semiconductor. So I think this is not only a growth stock, it's actually a good value stock today as well. So the 5 stocks that I think are great growth stocks that you may not have been aware about: Mobileye, Matterport, On Holdings, Portillo's, and Taiwan Semiconductor. Which one of those stocks sticks out to you? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.